the municipal bond myth, and why you're risking your financial security. Hi, I'm Brian Rezny, president of Rezny Wealth Management. If you're thinking tax-free municipal bonds are a safe, smart investment for your portfolio, you might be making a costly mistake. Today, I'm going to explain why municipal bonds aren't what you think, why chasing tax-free returns could jeopardize your financial security, and what you need to do to protect your investments and retirement. Let's dive in. First, let's talk about the tax-free myth. Municipal bonds are often marketed as a safe way to earn tax-free income. But here's the reality. Tax-free doesn't always mean better. When you calculate the after-tax returns of municipal bonds compared to taxable investments, munis often come up short. Why? Their yields are typically lower to account for the tax advantage, but for many investors, especially those in lower tax brackets, the math just doesn't add up. You could be leaving money on the table by prioritizing tax savings over total returns. Now, let's look at performance. Over the last 10 years, municipal bonds have delivered disappointing returns compared to other investment options. According to data from the Bloomberg Municipal Bond Index, the average annual return for munis has lagged behind taxable bonds and diversified portfolios. In a low-yield environment, munis have struggled to keep up with inflation, eroding your purchasing power over time. If you're banking on these bonds for retirement income, you might be in for a rude awakening. Why do so many people fall into the municipal bond trap? It's simple: the fear of taxes. Too many investors make emotional decisions, chasing tax-free income without considering the bigger picture. Taxes are important, but they shouldn't drive your investment strategy. By focusing solely on avoiding taxes, you might be locking your money into low-return, underperforming assets, sacrificing growth and long-term security for short-term tax relief. Here's where it gets interesting. Taxable investments like corporate bonds or diversified stock portfolios often deliver better after-tax returns than municipal bonds, even after accounting for taxes. For example, if you're in a moderate tax bracket, a taxable bond yielding 5% might net you more than a tax-free muni, yielding 3%. And with a properly managed portfolio, you can use strategies like tax loss harvesting to further minimize your tax burden without tying up your money in low-yield munis. Another misconception that bonds, including municipals, are safe investments. The truth is, bonds have volatility too. Interest rate changes, credit risks, and market fluctuations can cause municipal bond prices to swing, sometimes significantly. In 2022, for example, rising interest rates caused many bond portfolios to lose 10 to 15% of their value. If you're counting on munis to be a rock-solid foundation for your retirement, you're taking on more risk than you might realize. So, what's the solution? Stop chasing tax-free myths and start focusing on what really matters. Building a diversified, dynamic portfolio that maximizes your after-tax returns while managing risk. That's where Rezny Wealth Management comes in. Our team specializes in timely, decisive, and beneficial portfolio changes to help you achieve your financial goals. Whether it's optimizing your investments or securing your retirement, we're here to guide you every step of the way. Don't let municipal bonds or outdated investment strategies jeopardize your financial future. We'll discuss how we can help you identify opportunities for growth, grow your retirement income, secure your retirement, and create a plan tailored to your needs. Your financial security is too important to leave to chance. Let's make your money work harder for you. Rezny Wealth Management, your partner for financial security. Visit reznywealth.com to schedule your consultation today. Be sure to share with your friends and family so they can have access to investment updates to better their future.